This is chapter 14, part 2, and we just finished up part 1 by looking at the horizontal analysis, where we're looking year over year at the income statement. We're looking at the increase or decrease and then calculating the percentage change. And we talked about how this is not necessarily the best way to look at profitability, because it requires us really to look at the percentage change in the components relative to the change in sales. And even when we do so, it's very hard to quantify what that actual change is for that particular component. So for instance, selling expense increased at 35%, which is lower than the increase in sales. So we know that selling expense was probably went down. However, we don't know by what magnitude, and so it's very, very difficult to calculate out mathematically. So what we're going to do is we're going to use the vertical analysis instead. And what we're going to do is we're going to set sales equal to 100%. And from there, we're going to take each component part and express it as a percent of sales. So for instance, in 2018, cost of goods sold would be 60 divided by 100, or 60%. Gross profit margin, that would be 40 divided by 100, or 40%. And so on and so forth. So I'll just fill out the rest of this. These were easy because they were all out of 100. And same thing in 2019, we're going to start off by setting sales equal to 100%. Cost of goods sold, we take 97.5 divided by 150, and we end up with 65%. Gross profit margin, same thing, 35%. And I'll just fill out the rest of them, 18%. 8% gives us 9% operating profit, 1% other expense, total of 8%. So that's what it looks like for each year using the vertical analysis. And so from here we can get an idea of profitability relative to sales. And this is going to be more important because it allows us to quantify the real change from year to year. Now here we can see that, in fact, if we look at the net income level, we can see that, in fact, 2019 at the net income level is more profitable. We were at an 8% profitability level versus 7% the prior year. And that even made sense when we looked at it from a horizontal analysis, because we saw that, in fact, net income grew at a faster rate than sales, and so therefore we were more profitable in the current year versus the previous year. But let's take a look by going back up at the top of the income statement. Let's look at gross profit margin. Last year we were at a 40% rate, and we fell down to 35% versus sales. So gross profit margin actually declined by 5 percentage points. Okay, not 5%, but 5 percentage points as it relates to sales. So is that good or bad? Of course that's bad. It really reflects the fact that our markup, in other words, our sales price relative to the cost of our product, has declined. So whatever we're selling it for versus what we paid for it has dropped. It was a 40% markup, and now it's a 35% markup. So what are the causes? Well, one would be just the pure cost. The cost of the products that we purchased may have increased. Okay, and for whatever reason, we weren't able to pass that through in the form of pricing. And so therefore, we might have been, that might have been the reason. The other possible reason might have been the fact that our actual pricing of our product, our sales price, might have declined. Okay, so the fact is that it might be that overall, the pricing of our products or the mix of our products was such that we were actually achieving a lower per unit selling price. Now, of the two, obviously the pricing would be the most concerning, because a lot of times companies that experience higher cost of goods sold can simply pass those on to the consumer in the marketplace. Where it does become concerning is when you no longer have that pricing power or that competitive advantage in the marketplace that allows you to increase your prices to the consumer. That could be through competitive reasons. It could just be from lack of innovation. It could be because your business is really in a state of decline. And so that's very, very concerning. So in this particular instance, looking at the company, if it really was a matter of the fact that our pricing was actually declining, that would be something that would have to be addressed absolutely immediately. Because otherwise, a simple increase in cost, for instance, if you're Apple, Apple passes those price increases in the cost of their materials and the cost of their production along to the consumer. And they maintain that gross profit margin. In fact, they even expand it, to be honest, in certain situations. So, again, very concerning if, in fact, the reason for that drop is due to pricing. Now, here we can't tell. We'd have to look at, we'd have to have this information on a per unit basis so we could really tell if the price per unit was dropping or if it was the cost per unit that was increasing, or it could be a combination of both. Okay, so the next level we would want to look at is operating profit, and that's usually the number people focus on when looking at the overall company. And here we see again that we were down, this time though by only 1 percentage point. And again, that's a function of the fact that our gross profit margin was down by 5 points, and we did manage to make up some of that profit by reducing our expenses. So selling expenses reduced by 2 percentage points, and administrative expenses were reduced by 2 percentage points. So let's talk about administrative expenses first. Administrative expenses are expenses that do not generate revenue. So those are expenses that are like insurance, property taxes, the accounting department, things like that are necessary expenses, but don't drive revenues, don't drive growth in the company. So those are the type of expenses that we'd want to control and make sure that they don't grow at a rate that's faster than sales. And in fact, here that's what's happened. We've managed to actually reduce those as a percent of sales. So unless we've cut out essential costs, overall that would probably be a positive development. That would be good. Selling expense, I think on the other hand, we can look at really kind of two things that are going on here. So in selling expense, first of all, selling expense generally drives revenues, okay? So selling expense is an area that you do not necessarily want to cut costs, okay? Selling expense is where our sales, marketing expenses, promotion expenses, advertising, internet marketing, all of that stuff takes place. It's also where our product development, research and development, all our innovation related expenses take place that hopefully separate us from our competition. So that's generally speaking the last place we want to cut costs. So if it drives revenue, in other words, if it generates revenue or growth, then cutting these expenses would be a bad thing. Okay, we would not want that to happen. If these are revenue generating expenses or activities, we would definitely not want to do that. However, if these were expenses that were not driving revenues, in other words, they were not effective in producing sales, and we were cutting them, then in fact that would be a good thing. Okay, so for instance, we run a Super Bowl ad. It's funny and everything, but the next day no one remembers what company even put it out. That would be basically ineffective. Probably would not drive any sales of the product, so therefore that would be an expense that should not be made. That should be cut. However, if it's getting rid of our R&D, research and development, innovation, marketing, advertising, things like that. If we're cutting those costs simply for the sake of just trying to cut costs to keep our net income higher, then that of course would not be a good thing. That would be a bad thing. Okay. Other expenses. So basically at this level, the business is not actually making money. And in fact, selling expense is a little suspect because we might actually be cutting some costs that we actually need. And on top of that, we might have a real pricing issue. So at first glance, yeah, we're making more money, we're more profitable, things are great. But now that we've dug in a little deeper, we could have some severe issues here with the company. And even at the net income level, the reason it is positive is because we reduced our other expense from 3 down to 1.5. And you would have to ask yourself whether that's a sustainable level. Maybe it may go back up to 3 in the future. What were those other expenses that we were able to cut? And is that going to continue to happen in the future? So anyway, this is a type of analysis that would be extremely important, is extremely common, and can yield tremendous insight into what the company's doing. It can be done this way, comparing it to the prior year, but can also be done, so this would be like, say, take this as a common size income statement and compare that to your competitor, compare that to the competitors in the industry as a whole, and see how you're doing relative to them. And that could also yield some important information. And if we have time on our Zoom meeting, I'll tell you a little story about how a stock analyst was doing this, using a vertical analysis to compare a company versus others in the industry. Found out something very unique by doing that, specifically at the gross profit line, and used that information to basically make a stock trade for his firm. So it wasn't inside information. It was purely from doing analysis, doing the homework. And that trade ended up netting the firm, I think, somewhere in the range of $100 million profit. So just from doing a simple analysis like this. Obviously, a lot more homework went into it, and some research then, and some follow-up clearly, and then obviously someone needed to pull the trigger on a trade to take advantage of that. But nonetheless, the basic idea came from this type of analysis. So very powerful. So anyway, so we'll talk in the next part about using some ratios to evaluate liquidity and profitability.